Okay, let's just start with this number. Negative 5.26%. Yeah, in a single day. This isn't just a number. It's the kind of figure that makes your stomach just drop. A really brutal, shocking plunge that left every single investor asking one question. What on earth just happened? And this is where that number came from. The Korean stock market, the KOSPI. I mean, just look at that giant red candle. It was a complete and total free fall. The market didn't just dip, it absolutely crashed through key technical levels. It literally erased weeks of gains in just a few hours. But here's where the story gets really, really strange. On the very same day this was all going down, a huge player, SK Hynix, one of the world's biggest memory chip makers, they announced record-breaking profits. So you've got record profits on one side and a catastrophic price crash on the other. It's the central paradox here. It just doesn't make any sense. Or does it?
All right, so let's really dive into this. Because if you were just reading the headlines, you probably heard a bunch of simple, easy explanations. But the real culprit, it wasn't a person, it wasn't even a single piece of bad news. It was something faster, colder, and way more powerful. It was like a ghost in the machine.
And, that ghost actually has a name. Risk parity. Now, this is a pretty sophisticated strategy used by some of the biggest hedge funds on the planet. The core idea is to balance your portfolio not by how many dollars you put into stocks versus bonds, but by balancing the risk of each of those assets. And this is kind of what that balance looks like on a normal day. On one side of the scale, you have your volatile stuff, like stocks. And on the other, you have your supposedly safe assets like gold and bonds. So to make the risks equal, the fund uses leverage, basically borrowed money, to own a lot more of the safe stuff. When it's all working, it's a perfectly balanced, beautiful system. But what happens when the safe side of that scale suddenly starts to shake? Well, that's exactly what happened here. The assets that were supposed to be the stable bedrock, gold and bonds, they suddenly became incredibly volatile. And when that happens, a warning siren just goes off across the entire system.
And this is the automated chain reaction that kicks in. Step 1 is the trigger. Those so-called safe assets get volatile. Step 2, the system's own risk limit, it's called value at risk, or VAR, gets breached. Alarms start blaring inside the algorithm. And that triggers step 3, an automatic, non-negotiable command to deleverage. That means sell assets, reduce risk, and do it now. No questions asked.
So the key here is that the algorithm has to sell. This global portfolio is in deep trouble. But that brings up the next obvious question, right? Why Korea? Out of all the places in the world, why did this global problem cause such a massive, concentrated sell-off in the Korean market? To understand why, you gotta stop thinking like a person and start thinking like a machine. An algorithm doesn't ask a human question like, which of my investments has poor future prospects? No way. It asks a purely mechanical and, frankly, brutal question. What is open for business? What's super liquid? And what can get me cash right this second?
And the answer to that question was SEOUL. While all the US and European markets were dark, Korea's was alive and buzzing. It is one of the most liquid and accessible markets in the entire world. So the Korean market wasn't targeted because it was weak. It was targeted because it was the only global ATM that was open at that hour.
So that's the theory, right? A Warsh Shock in these global funds forced them to use Korea as their emergency piggy bank. But where's the proof? How can we be so sure this wasn't about something fundamentally wrong with the Korean economy itself? Well, let's follow the evidence in the data. This heat map basically shows the algorithm's fingerprints all over the crime scene. Just look at it. It's a sea of red. The selling was completely indiscriminate. Tech, manufacturing, consumer goods, financials, pretty much everything got hammered. This wasn't some surgical strike on a bad sector. This was a carpet bombing. The kind of thing a machine does when it just needs to sell anything and everything it can get its hands on. And if you need a smoking gun, this is it. While the high-flying tech sector was absolutely imploding, look what happened to a classic low-volatile defensive stock like KT&G. It was bright green, up over 5%. This is the proof. Capital didn't just disappear from Korea, it hid. It fled from high-risk tech into the safest possible corner of the exact same market, a classic textbook machine-driven risk-off rotation. So what's the timeless principle we can pull from all of this? Well, it's a lesson that applies way beyond just one day in one market. During a liquidity crisis, the normal rules, they just get suspended. Your company's record profits, its brilliant new product, frankly, none of it matters. The only thing that matters are the raw mechanics of the market. Who needs cash and where can they get it the fastest? It's just a powerful reminder that sometimes what drives the market isn't human opinion, but the cold, hard logic of the machine.